Welcome to Part 4, Chapter 9. We're going to be looking at disposing of plant assets, and we'll be computing periodic depletion of natural resources. Plant asset disposals. You either use an asset until it's retired at the end, for our staying with our truck example, that would be at the end of 5 years, or you might sell it at the end of its life or even before its life is over. So of course we're going to be dealing more with the second example when it's sold midlife or disposed of midlife. So the rule is you record depreciation up to the date of the disposal, and then you have to take the asset off your books, which means you debit the accumulated depreciation account for the amount of the accumulated depreciation, and you credit the asset account. So let's take some examples. Now, I gave you a journal entry form, and if that's not big enough, just attach another form to this. But you do want to have examples of all the journal entries that we have. So let's take an easy example. Maurer Enterprises retires its computer printers, which cost $40,000. The accumulated depreciation on these printers is also $40,000. The journal entry to record this asset is what? Now, a couple things we're assuming here is these printers had a salvage value of 0. So when this asset is fully depreciated, it has a 0 book value. So the only accounts we need to worry about are the accumulated depreciation, $40,000, and the equipment, $40,000. And you can see here that they've actually named an asset account printing equipment. That's not really necessary. You can just call that equipment for simplicity. But what happens if a fully depreciated asset is still being used and it's by the company? Well, you don't retire it. You leave it on the books. You'd have $40,000 in accumulated depreciation and $40,000 in equipment. All right, let's make it more complicated. Let's assume that Morales Company discards delivery equipment that cost $19,000 and has accumulated depreciation of $14,000. In other words, it's still got some life left to it. It's still got $5,000 on its books. How would you dispose of this asset? Well, the first thing you do is clear out the equipment account. So we know that equipment has a $19,000 debit balance. So we're going to credit equipment, $19,000. And again, you could just use the account title equipment. You don't have to be so specific here. Accumulated depreciation has a balance of $14,000, credit. So to clear it out, we debit accumulated depreciation. Now, if we just had that debit of 14 and that credit of 19, this journal entry would be out of balance. So what does it take to balance this journal entry? A debit of $5,000. You can see that we had a book value of $5,000. Since we disposed of this asset, we didn't sell it, we just disposed of it, we are taking a loss of $5,000. And we have a new account title, loss on disposal, $5,000. And companies will record this. Loss on disposal is an income statement account. It's an other expense, and you will record those in the category other expenses section of your income statement. What happens if we sell an asset? Well, then we bring cash into the company. If we get more money than the book value, then we're going to record a gain on disposal. If we get less money than the book value, we're going to record a loss on disposal. So let's take two examples. First one, a gain on disposal. Assume that on July 1st, Wilbur Company sells office furniture for $16,000 cash. The furniture originally cost $60,000. And as of January, not July, but January, it had an accumulated depreciation of $41,000. Depreciation for the first 6 months of 2011 is $8,000. Prepare the journal entry to record depreciation expense up to the date of the sale. Now you're going to have to catch up depreciation. So the first thing you do is record depreciation as of the disposal date. Now, in this chapter, we only have shown examples where we record depreciation for a full year. If you dispose of an asset mid-year, you've got to prorate it. So they've done the proration for you. It's $8,000, so we'll just book that depreciation. Next step is to dispose of the asset. Now, we knew that $60,000 was the original cost. 41 plus 8 for the current year depreciation is going to be your accumulated depreciation. So you have a book value of $11,000, but we sold this furniture for $16,000, so we get a gain. So what do? First thing, we credit the equipment account at full value, original cost. You never credit the equipment at book value. You credit it at original cost. Otherwise, you'd be leaving a balance in the account. You debit accumulated depreciation as of the disposal date, which is including the current year, $49,000. And you have a debit and a credit, and you're going to show the cash coming in. Okay, now those don't add up, do they? 49 plus 16 is equal to $65,000 in the debit side, and we only have 60 on the credit side. So we need to recognize a gain on disposal. Gain on disposals, an other income account. It's got a credit balance just like service revenue, just like sales. So gains are a good thing, credit, and that's why it's a credit. Losses are a debit. Let's take a loss. Assume the same fact pattern, but instead of selling the furniture for $16,000, we're selling it for $9,000. Now you can do the math and you can figure out we lost money on this. Book value $11,000, but we only sold it for $9,000, so we lost $2,000. So the journal entry is almost identical. You've got your credit to office equipment, your debit to accumulated depreciation, clearing those two accounts out. Again, office equipment at full value, not at book value. Debit cash coming in. Now you've got 58 on the debit side, 60 on the credit side, and you need a debit to balance. So we are going to record a loss on disposal. So losses are like expenses. They both have a normal balance of a debit. Gains are like revenue. They both have a normal balance of a credit. All right, next topic, natural resources. Natural resources, you just need to know this in theory. You don't need to do depletion schedules. You don't need to do all the journal entries. But it's important you understand what we're talking about here. Natural resources, standing timber, underground deposits of oil, gas, or minerals. They are physically extracted, so they're replaceable only by an act of nature. So if you mine gold out of a mine, eventually you've mined all the gold in the mine. If you are pumping oil, you will eventually, the oil well will run dry. And if you're cutting trees, it will take time to replenish those forests. So we have, in this chapter, we have dealt with depreciation, which deals with tangible assets. Natural resources is not depreciated, it's depleted. And then at the end of the chapter, we're going to talk about intangible assets, and we amortize them. And they're all essentially under the heading of amortization, where you write off an asset. We just have different terms depending on the type of asset. So cost is the price needed to acquire the resource and prepare it for its intended use. And depletion is done the same way. The journal entries are very similar to depreciation. Companies generally use units of activity. So for example, in a mine, they have to estimate the value that they think is in the mine and estimate what % they've depleted. All right, so real quick example. Assume that Lane Coal Company invests $5 million in a mine, estimated to have 10 million tons of coal and no salvage. In the first year, Lane extracts $800,000. Lane computes the depletion expense as follows. Original cost divided by the capacity is 50 cents per ton. We mined 800,000 tons. So therefore, we have a depletion expense of $400,000. Depletion expense and accumulated depreciation or accumulated depletion. This concludes part 4. Let's go on to part 5, our final part.